name is Tanya Macheel. I am a crypto reporter at CNBC. You see me kind of everywhere on the .com side, on TV, and I host our digital show, Crypto World. We have an amazing panel today and so many subjects to get through, a lot of perspectives here. So I do want to go down the line, starting with Adam, just a quick introduction, and then we'll get right into it.
So I'm the CEO and co-founder of Blockstream, which is a Bitcoin layer 2 company, and also in the Bitcoin-centric asset management space. I was involved with Bitcoin very, very early, before the network started, because I had designed Hashcash, which is the proof of work algorithm that the Bitcoin miners use. But yeah, so.
I'm Dave Lavelle. I'm the global head of ETFs at Grayscale Investments. We're the largest crypto asset manager in the world, and most notably, probably most well known for suing the SEC and kind of getting the Bitcoin ETF over the finish line, which opened up the market quite a bit.
Hi all, I'm Manoj Vasudevan. I'm with the KAUST Investment Management Company. KAUST, for those of you who don't know, stands for King Abdullah University of Science and Technology. So we're basically the endowment fund or the investment arm of the university. The university is in Saudi. Fun fact, it's got the largest university campus on earth, about 8,000 acres of contiguous land. The endowment is one of the 3 largest university endowment funds in the world. We're managed we're managed by a former World Bank team, and that's why we're based in Washington, DC. Our journey into blockchain and digital assets goes back to 2018 days.
Hello, everybody. I'm Paul Brodsky. I'm a partner at Pantera Capital. Pantera Capital is a firm founded originally in 2003 as a macro-style hedge fund by Dan Moorhead, who ran macro trading for Julian Robertson at Tiger Management. In 2013, we went all into Bitcoin when it was trading at $65 US. It's been quite a good trade. Since then, we've been involved in mostly venture equity, as well as private and public tokens. We're currently on our 5th capital raise, and I'm thrilled to be here very much and look forward to the conversation.
All right, thank you. Manoj, I want to start with you. So KAUST is one of the largest university endowments, and I've been covering crypto for more than a decade now, and I just remember all of these big Bitcoin fans back in the day saying when the endowments jump in, that's when we'll know that Bitcoin is really kind of taking off. Can you talk a little bit about the approach into the digital assets world and how it differs from traditional approaches?
Right. So, just a little bit on the journey itself. Our journey goes back to 2018. It was sort of the year when you saw the first flavors of institutional involvement with some of the traditional allocators like the endowments and foundations and other family offices getting involved. So we also noticed a number of our fund managers, like incredible people at prestigious venture capital funds in Silicon Valley. Those guys started leaving to join crypto funds and crypto startups. That was a trend we did not want to miss. And in the fall of 2018 was when we made our first token investment into the space. It was a venture fund in crypto. Fast forward to 2021, we sort of like learned the space alongside our manager. And that was when we really came up with a robust thesis as to like why crypto, why blockchain, why have it as a dedicated asset class within our venture portfolio. And that's what helped us really continue investing into the bear market of 2022 in the aftermath of FTX to a point where it is low single-digit exposure for the endowment, which is quite meaningful in an absolute sense. And the way we've approached the space is more holistic. It's not one of the many technologies that we invest in and just sort of wedged into the venture portfolio. It is its own asset class because it's not just a market in our minds. It is also it has its own financial instrument, which is what we call the token. So we think of it as a unique asset class with extra liquidity. So it sits within our venture plus bucket. Whether it is venture funds, whether it is liquid directional funds, whether it is liquid market neutral funds, it sort of all sits in our venture plus bucket, which is a category that I don't think most institutions have. We've sort of like created it because crypto doesn't typically sit neatly into the strategic asset allocation for most institutions. So we had to innovate on that side. So.
Something I got from a lot of your introductions is just how different the crypto world is today versus back then. And Adam, you have been, building crypto infrastructure since the very beginning. Can you talk a little bit how the infrastructural needs for institutions has changed since the early days?
Yeah, I mean, of course, for the first few years, Bitcoin had no price and no market, and the early exchanges were technologically immature. So I think that's grown up over the years. And Blockstream made an investment Blockstream Capital Partners made an investment in Kamenu, which is institutional custodian. So I think that's a new phenomena where, due to exchange security issues, a number of bigger traders have asked the exchange to allow them to trade with a balance that's actually held by an independent custodian, which is actually the way everything works in the traditional world. And so I think that's now bringing the crypto market, the Bitcoin market, into that organization, which sees an independent custodian holding the underlying assets. Of course, it's much more important to do that with Bitcoin, because if it's lost, right? With a share certificate, it's an error, you can replace it. So that's the latest evolution. And then Blockstream is also a technology company. We've been working on Bitcoin layer 2s and fundamental Bitcoin improvements over the years since 2014. And one of the layer 2s we work on is something called Liquid, which is kind of settlement layer for Bitcoin and digital assets. So conventional shares, tokenized, corporate bonds, longer tail assets, and that enables you to do a non-custodial trade. So the individual trading firms or individuals can keep custody of their assets in a hardware wallet and still place a limit order and have that matched on a central order book. So we're quite enthusiastic to see that kind of self-custody technology that is ultimately the point of a blockchain actually be used by the trading venues.
Paul, coming to us with the hedge fund and VC perspective, you have had time in both. You started your career on Wall Street, came to crypto through Pantera in what I consider still the early days, went back to the traditional finance world, and then came back to Pantera. Can you talk a little bit about the changes in infrastructure in crypto in all of your time?
Sure, it's hard to know where to begin, because there's been so many changes. There used to be so many impediments, as Adam alluded to. First, institutional investors most of them, or many of them, are fiduciaries by trade, and they have to make sure they can invest in assets that won't blow up to begin with. And there was really no understanding of the crypto market when it first began. There was no market regulations to speak of, certainly in the U.S., and it was a huge challenge. And so it was not really attractive to fiduciaries to take the risk. Second, I would say, there was no capacity. Even if the market was a small market, even if there was great opportunities of investing in something that would produce 100x or 200x returns, you wouldn't be able to allocate enough capital to make it worthwhile to your organization. Custody, a huge one, as Adam mentioned. Dan tells the story of raising a few $100 million for the Bitcoin fund in 2013 or 2014, and he had to walk around with a thumb drive in his pocket with the alphanumeric codes for the wallets, and it was and that's really no way to run a fund using best practices that people are used to. Obviously, understanding. Manoj and I were talking in the green room, and really it's the narrative that people just don't get. It's hard if you're a member of a investment board used to a hierarchical decision-making process to suddenly say, oh, well, no one's really in charge of the blockchain. It's a democratic process. It's user-owned, user-managed, and that's really difficult to get your head around. And so, all these things have been knocked down layer by layer to the point now. Use cases. There hasn't been, except very recently, I think, there hasn't been a real chat GPT moment like you see in AI, where retail, the public, can actually get online and see, wow, this thing is really powerful. That's coming, maybe in the form of stable coins or whatever it may be, but you will begin to see in the next couple of years, I think, payment systems using stable coins on blockchains that are cutting out intermediaries, and that's going to be a very powerful thing. Once we get used to that, then you'll begin to see, oh wow, this is really legit. And so I think all of these things have been major transformations that are going to produce significant interest on the part of institutional investors.
So Dave, I need you to jump in here. Paul just touched on custody and infrastructure and regulation and use cases, and Grayscale is at the center at and really was a leader in led the charge on Bitcoin ETFs. How have these funds, which have shown extreme popularity, kind of changed the institutional approach to Bitcoin allocation and access?
Yeah, there's a couple ways to tackle that one. First, it was a vision that we had from 2013 because our founder had deep conviction that this was going to be something that people were going to want to allocate to and going to want to have in their own portfolios and their clients' portfolios alongside all the other asset classes. So the product in 2013 was built to be exactly like GLD was constructed, so that it could ultimately be converted into an ETF, which obviously happened in the beginning of 2024. Now, I think everyone pretty much rushes quickly to like all of the inflows, but the reality is institutional adoption of the Bitcoin ETFs hasn't really happened. Now, the Bitcoin ETF story is the same story as all other ETF stories of democratizing an asset class or democratizing an exposure. But in all other cases of ETFs coming online with different asset classes, it starts with kind of an institutional class of investment and then kind of permeates or kind of democratizes to retail. In the case of Bitcoin, it was a strange barbell approach where you had individual enthusiasts and you had kind of the smartest institutions of the world that kind of were early adopters into the asset class or early adopters into the technology. And so when the ETF launched in the beginning of 24, it was a real inflection point for the entirety of the institutional marketplace, not only on the investment side, but on kind of the infrastructure side. So I'll take a little bit of a different angle on institutional adoption. Jamie Dimon may have been saying like no to Bitcoin, but JP Morgan was at our front door pounding the table saying, we want to be an authorized participant. We want to be able to create redeem. Goldman Sachs was very similar as well. And I think when I say that institutional adoption hasn't fully happened yet, it's because the 30 trillion in wealth that exists in wirehouse wealth management platforms haven't really onboarded the Bitcoin ETFs yet. So everything that you've seen, the 125 billion that has currently been allocated, the vast majority has been self-directed money. And so if we have a 1% allocation in the 30 trillion in wealth at the advised market, you're talking about nearly 3 times the size of the ETF market right now. So it just hasn't happened yet.
You mentioned GLD, Dave, and so I cover the markets and investing trends slice of the crypto beat, and I talk to analysts, investors every day, and the one thing, not the one thing, but one of the things that it seems we cannot overcover and people simply still have trouble wrapping their heads around is the correlations. And we saw some interesting activity recently with Bitcoin and gold, where you started to see Bitcoin do what a lot of people have always said it was supposed to do, which was its own thing. It can rally with stocks. It can also rally with gold. It, is perhaps both instead of one or the other. How do you, Paul, view that narrative? Do you see it as one or the other? Do you see it as its own thing? I'm sure you've been asked, how do you compare this digital asset to what we already know? What do you say?
Well, at one point in my life, I had a macro fund and did a lot of work really from 2007 to 2011 on gold. And so I'm pretty comfortable with gold, as I think Manoj is as well. And it all comes down to monetary inflation, I think, and both gold or precious metals and Bitcoin, digital gold, as it's referred to, as you mentioned, they have an inflation rate of about 1.75% every year, give or take, depending on the year, depending upon how much gold is mined in the year, depending on how much Bitcoin is mined and lost, but we really don't know. But it's something more stable, whatever it is, than fiat, than what we see central banks around the world, fiat central banks around the world creating and distributing. And at some point, savers, meaning savers and investors, are probably going to begin to diversify in greater proportion out of fiat and fiat-denominated assets into gold and crypto. I think a lot of it has to do, the correlation, as you start to bring up, will have a lot to do with a generation gap. I mean, you know, I am in the tail end of the baby boomer generation, and yet I'm in crypto. And I think it's because digitization is going to impact money the same way it's impacted everything else. If you look at the 36 trillion and counting, and with the big beautiful bill, regardless of what your thoughts are politically, it doesn't matter, but both in the US, both parties can't cut. They just can't cut the debt. So it's going to grow, and it's going to grow ever more faster, may turn into a separate monetary order that we see, or a different or a modified monetary order that includes digital assets, includes Bitcoin as a basis, maybe along with other things. The dollar is a reserve currency. Certainly it's stronger, or should be over time stronger, or more trusted than other fiat currencies. However, there's for the first time going to be a choice of savers. Once payments begin to take hold, it'll be very interesting how it plays out. But I think I would bet that one quick thing, I apologize. I know that our Treasury Secretary now, his largest holding personally is gold. And he said so publicly. Historically, the reason that central banks own gold is because it's the only asset on their balance sheet that is not debt. It's in the event that they have to devalue their currency. And really it only matters to the Fed, and because we're the reserve currency, the US dollar is the reserve currency. The way it would work very quickly is they'd pick a number, say $20,000 gold, and they'd QE, they'd print the money, and tell the world that they'll buy any and all gold at $20,000, at which time they would peg the dollar to gold, and it would stabilize the fiat market across the world. It would ruin the value of your bonds in real terms, but not in nominal terms, and that's how they would get out of it. So there is good reason that gold is on the balance sheets of central banks. If that were to happen, something that seems outlandish, something like that, if that were to happen, I would guess Bitcoin would, gold goes up 5x or whatever it might be from current levels. Bitcoin would probably go up twice or three times that because it's under-owned. So there's a reason not to say necessarily gold is better than Bitcoin, Bitcoin is better than gold, but I think you'd be buying volatility. At some point, they would reach equilibrium where you're indifferent whether you give up your gold or Bitcoin or dollars for a stick of gum.
Saw a lot of head nodding from Manoj. Can you weigh in on this? How does Kaust approach Bitcoin versus gold? Do they complement each other in a portfolio, or should they be bucketed differently?
So if I were to just summarize the difference between gold and Bitcoin in just one sentence, it would be that gold is an established store of value, Bitcoin is an emerging store of value. And it's the 2 trillion market cap versus the 20 trillion market of, or whatever it is, the 18 to 20 trillion market cap that gold has. And the way we think about, I don't know how many allocators are in this room, so if you think about just the endowments and the foundations, it's close to $1 trillion of AUM. The vast majority of that AUM does not own gold. They don't care about store of value in a certain sense, right? And they apply the same to Bitcoin. But what Bitcoin, the way Bitcoin is different and the way we play Bitcoin as well, obviously we value the store of value attributes with respect to scarcity, with respect to its network effects. But at the end of the day, we try not to complicate Bitcoin, because you can go down an incredibly deep rabbit hole in terms of like making a 1 to 3% allocation work for the rest of your portfolio. But we just think of it as a venture bet. It's a de-risked venture bet, and the bet that we're making is it's going to go from an emerging store of value to an established store of value. We are betting on the $2 trillion to $20 trillion journey, if you will. And when you take that approach, it sort of simplifies things to most allocators, because most allocators have all sorts of speculative venture bets in their portfolio. Bitcoin is not even speculative at this point in time, but it still has venture scale returns. And when you have that mindset, it's very easy to sort of include it in your portfolio without having an allocation mindset. It's just another venture bet you can make, and you can make it in size because at this point in time, it's de-risked. And we all will probably agree Bitcoin's not going to zero at this point in time. And that's why I say it's de-risked.
Adam, I want to go over to you. How do you think global regulatory developments, and we've seen some nice progress in recent months, especially here, of course, and in Europe, how are these regulatory developments shaping institutional, I guess, confidence in this industry and in adoption of digital assets?
Well, I think it helps. There have been a lot of friction in the last few years, and that is improving in the US. The repeal of SAB 121, of course, the spot ETF, which Grayscale was instrumental in getting passed under the previous administration, and more open for business environment, where, for example, the traditional custodians like State Street have been cleared to custody Bitcoin, so presumably those type of players will enter the market. These are all good things for, so Blockstream is in the asset management space, targeting pension funds to address the shortage of dollars in the Bitcoin markets. There's a great shortage of liquidity. You can see that flow through into very high funding rates and into inefficient pricing. So you can see that from the pension manager's point of view, the clarity in regulation is useful to them. Being able to work with a custodian that they recognize that they already have as a custodian for shares and bonds and other positions is useful. So I think that's all part of reducing hurdles. Now I think the other thing that helps, pensions which are a bit more conservative than endowments perhaps, to go forward is seeing other funds participate. So the Abu Dhabi Sovereign Wealth Fund, one of those participated. And BlackRock's kind of model portfolio, which actually matched, coincidentally, so we said on the panel 1 to 3%. Sean Bill, who's sitting in the audience, the CIO at Blockstream, put that to the Santa Clara VTA when he was the manager there before stepping back into the pension fund space. That was actually exactly the same allocation, 1 to 3%. That was the first US pension fund in 2021. To get Bitcoin onto the balance sheet, and BlackRock's model portfolio actually is a very similar argument for a 2% allocation. And it's basically that, some of the pensions have unfunded liabilities. If you put 2% in, if Bitcoin doesn't perform, it's a small risk that can be recovered in the rest of the portfolio. And if Bitcoin continues its trajectory towards catching up with gold, or that's the 20 trillion that was mentioned, or goes on to sort of demonetize the monetization of lots of different assets that, real estate, bond market, and the M2 monetary expansion flowing into the stock market. So if it pulls some of that out, there's potential for as much as 200 trillion. So as long as it continues on that direction a bit further, they don't have to form an opinion about how far. That can have an outsized effect so long as they don't rebalance. So, they're addressing the volatility by size and then staying the course for 5 or 10 years and seeing where that goes.
And Dave, you, I'm sure, are familiar with some of that research that Adam just cited. Based on where you sit at Grayscale, working on ETFs, what is your view of institutional adoption today versus your outlook for it in the next 3 to 5 years? Where is this going?
So the conversation right now with traditional institutions, and I'll use an example of 5 weeks ago, I was sitting at a conference speaking to $3 trillion worth of state treasurers who are rapidly seeking the opportunity to change their charter so that they can make an allocation to Bitcoin alongside the cash that they have on their balance sheet for all the same reasons that they're concerned about the devaluation of a significant asset that they're holding on their balance sheet. And I think it's really about a conversation around, well, this is a volatile asset. It has kind of like up and to the right, return profile. But, the confidence that people now have in saying that Bitcoin might be volatile, but it's not devaluing, is a major hurdle that institutions have gotten over. And it allows them to make a more confident allocation because they have the opportunity to believe that it's going to be something that's going to protect them against devaluation of the currency, and also have that upside return profile. And as there's a broader adoption to Bitcoin, it will reduce that volatility, behave more like a traditional currency based upon the cash flow of the underlying asset. And that's the real conversations that we're having with institutions right now. I think that real allocation is going to happen in the near term, and I think a broader participation across the pensions, endowments, and insurance companies will come thereafter. But I still go back to the reality that there's 30 trillion in kind of institutional wealth in the form of model portfolios that live at the advised market. There's 80 trillion in wealth that's going to transfer generationally, and the next generation is going to want to have a solution, and Bitcoin's going to be part of it. So I'm no macroeconomist, but if you control the supply and you increase those demand inputs, it's going to be materially beneficial for the price performance. And so it's an easy story to tell, and people are really actually gluing onto it.
All right, we have 2 minutes left. I want to go down the line. I'm going to start with Adam and give Paul the last word. But what is one piece of advice that you would give to institutions who are sitting on the sidelines right now of Bitcoin?
I would say get off zero. 2% is a good allocation, and don't rebalance. Just stay the course.
I would say to continue having the conversations. If you're not comfortable with it yet, have the conversations with people who are comfortable with it, and it will click eventually, and you'll have confidence to make that allocation. It's too important to ignore.
I'm going to make it more broad-based with respect to blockchain. And it's important to liken blockchain to how the internet evolved and how it was adopted back in the 90s. So if you were to think back to the 90s, it wasn't totally clear as to how the internet would evolve. We all knew it was going to be important for communications. But beyond that, nobody could have predicted all the new business models and the new use cases, new categories of businesses like social media, search, cloud, gig economy, things that we couldn't even imagine in the 90s. These things were what the internet enabled, and it led to massive investment outcomes. The same is going to happen with blockchain. It's going to lead to massive investment outcomes because there are going to be use cases, new business models that none of us can envision now, 20 years further down the line.
Final word, Paul.
Well, since there is somewhat of a generation gap in the adoption of blockchain and the comfort with blockchain and cryptocurrencies, I'd suggest to institutional investors with formal investment boards that they give associates a little say and take them seriously, because what we've noticed within institutional investors the way they operate in their infrastructures, they've got a lot of enthusiasm among the younger people at their firms for getting involved, at least for getting off zero allocation to it. But they don't seem to have much sway. So I would say, listen to your younger people. They're very smart and they know the world's going to look like.
Okay, please give it up for this amazing panel. Thank you so much, everybody.